press and hold left
So
or
in the
right to
video where
X
we talked
speed.
about the closing disclosure, this is a snapshot of page 4 of the closing disclosure. If you want the full video, it's like 10 fucking minutes long. It's listed in our beginner series videos, and it's all about the closing disclosure, and we go through all 5 pages. One of the things that I mentioned in that video is that we're going to do definitions for some of the terms that come up here. So we're going to talk about four different things that are going to show up on your closing disclosure, and these are all loan related. These are all loan related terms. Specific to real estate only in the sense that this is only happening because you're buying real estate or borrowing money that's being secured against real estate. All right, so we're going to start off with the very first one. So this is the very top of page 4 of the closing disclosure. These are the disclosures that your lender is giving to you about your loan. Okay, so the first one, assumption. What does assumption mean? Assumption is whether or not another borrower can assume the loan that you just took out. In most instances, your loan is not going to be assumable. If you're using a conventional financing, meaning you're not using a certain program, your loan will not be able to be assumed by another person. There are some exceptions, and a lot of times this comes up in the situations with divorce where spouses are on the loan together. You have to go through your lender's process to find out whether or not you can assume that loan, even if it's not a traditionally assumable loan. The other loans, there's really only one that's assumable, and those are VA loans, Veterans Affairs loans. Those loans on their face are assumable. And what that means is that when you go to sell this real estate, one of the options that you have is to say, the loan that I have with this current lender is assumable, meaning you, buyer, have the option and opportunity, assuming that I am willing to allow you to assume the loan, you have the opportunity to apply with that lender to see if you qualify to assume my loan. It doesn't mean just because this loan is assumable that your potential buyer will just be able to take it over. That's not what that means. They still have to qualify. They still have to be able to meet the requirements of the lender in order to assume that loan. But that's what an assumption is. Is your loan assumable? Can another buyer take over your loan? And this is different, and we'll do another one just because this is something that you might see, where you take the property subject to the loan. That is totally different than an assumption. Stay tuned for that video. So assumption, is your loan able to be taken over by somebody else? With a gigantic asterisk that they still have to meet the lender requirements in order to do so. That box is going to say yes or no. Okay, number 2, the demand feature. Does your loan have a demand feature? You're probably right. What the hell is a demand feature? A demand feature is early repayment of the loan. And this is not because you have defaulted on the loan. If you default on your loan, your lender can call the entire balance due upon your default. That's where foreclosures come from. A demand feature means your lender, basically at their whim, there could be some... This is not related to when you are in default. There will be identified triggers as to when can your lender call your loan. Meaning, if your loan is 30 years, can they ask you to pay the entire balance prior to the maturity date? Most loans have no, they cannot, unless it's in the event of a default, meaning you have violated one of the terms of your loan. Primarily, you have not paid, or you've transferred the property and haven't paid off the loan. Okay, an early demand means your lender, under certain circumstances, they will outline in your agreement, in your note, when can they ask you to pay your loan before it's actually due. That disclosure will say yes, it has a demand feature, or no, it does not have a demand feature. The next one is a late payment. And really, this one, we're just going to talk about what a late payment is. So you do have a built-in grace period with most loans on when you have to pay your payment. So typically, your loans are going to be due on the 1st of the month, unless you and your lender talk about it being due on another day. You have the pay your loan on the 1st of the month. Okay, but what your late payment right here, what this is going to say is that, and you can't read it, this is really small. If your payment is more than 15 days late, your lender will charge you, and then that's what's going to tell you. So the things that are going to change in this paragraph, how many days and what is the penalty? Typically it's 15 days. You typically have 15 days to pay your loan without incurring a late fee. On day 16 is when you get that late charge. And that late charge is going to be a percentage point, typically, of the past due principal and interest payment only. So if you're making a mortgage payment and that includes your escrows for taxes and insurance, or you also have mortgage insurance rolled into there, the late fee will only be calculated based off of what was due for the principal and interest. Okay? That's what this little paragraph right here will say. You have this many days to pay, and if you don't, this is the fee that will be assessed on the monthly principal and interest payment. That's a late payment. And finally, let's talk about negative amortization. Negative amortization is real interesting. All right, so negative amortization, it sounds gross, and it kind of is. So the way negative amortization works is that your loan has some rule in there that you are making a payment and your payment is not sufficient to cover the interest that's due on that month. So for the sake of being easy, let's call it $1,000. Let's say that your monthly payment is $1,000, but the interest that accrues on your loan on a monthly basis is $1,500. Okay. When you make that $1,000 payment, you have a shortfall of $500. When do you pay that money back? At the end of your loan. The end of your loan meaning when you go to pay it off because you're selling it, refinancing it, or you're just done. You're done making principal payments on it. So you could be very surprised at the end of this and be like, why do I owe so much more money? And that's the problem, is that at the end, the amount that you didn't pay because of this negative amortization could end up being more than what the original loan was. And that's just because of the way interest works. It can also lead to situations where, well, it doesn't lead to situations. You typically find this situation with negative amortization when you're in an adjustable rate mortgage, ARM, adjustable rate mortgage. And there are limitations on what your monthly payment will be. So if there's a cap on how much you pay every month, so if your loan documents say you're only going to be paying $1,000 a month, but your interest rates are fluctuating up and down because it's an adjustable rate mortgage, there's a possibility that your minimum payment that you're making is not covering that deficit on the interest. So you're going to end up owing more at the end. That's what negative amortization is.